All right, everybody, welcome to another YouTube video. Today we are going to talk about call credit spreads. This is a more advanced option strategy, and I would also recommend, there's a book out there called Credit Spreads for Beginners. They actually cover call credit spreads and put credit spreads. I'll talk about put ones in a different video. But before I go any further, there are 4 simple things I want you to do if you are getting value out of my videos. Number 1, hit the like button. Doesn't cost you anything, easy to do. Number 2, subscribe to the channel. 3, share it with your friends. And then lastly, hit the alert so you get notifications when I release new videos. So I want to talk today about call credit spreads. And we're going to use an example. We'll use Apple and we'll walk through that. And you know, at the time, Apple, I think, is roughly about $155 a share. And this is as of July 21st, 2022, when this video was recorded. So I want to talk about call credit spreads. And they are great. They are great when you are you're bearish on a stock in a short term. So you might believe that the stock is going to either stay where it's at or go down. That's what you're doing when you sell one of these. And you do sell them, you don't buy them. So how does it work? Here are the mechanics. It is 2 legs. So what you will do is you will buy a call and you will sell okay, so you're going to buy a call at a higher strike price. You're going to sell a call at a lower strike price. Now, we're going to run through an example because with this, it's a little complicated unless we model it out. So they're great. Again, let's kind of review this. They're great when you're bearish on stocks and when you're on a stock. The max profit. So what you're doing here is when you sell this, you're selling what you would call a vertical spread here. You're buying an option and you're selling an option at the same time. Because there are different strike prices, the net of that is you will receive a small premium. That is your max profit. So what you want is you want this to expire worthless because that means you will collect the max profit. So let's go through an example. Okay? Let's use Apple, everyone's favorite stock. And let's say you sell a $170 strike call and you buy a $175 strike. And we'll say they expire 8/19. Okay? And premium for that, we'll say it's $30. We'll say it's $30, right? So let me break this down, what we're doing. Okay? I'm going to explain all of this because I know I have to write it all out and everything. So we have Apple stock. You don't have any shares. You don't have to have shares to do this. You do, let me say this before we go any further. You do have to have approval from your broker to write option spreads. That is generally like a level 2, but you can look on your broker. They may have different classifications for it, but what you want is you want a level 2 clearance or a clearance that will allow you to write vertical spreads. That's what you're looking for. And you will have to have a margin account to do that. But sorry, I keep thinking these things. But just because you have a margin account does not mean you have to use it. I don't use my margin account. I don't use the margin in it. I'm not borrowing or anything, but you have to have a margin account just to be able to do this. So here's what we're doing. Let's break this down. I'm going to buy a $175 strike call, which means I'm buying the right, not the obligation, but I'm buying the right that I can buy Apple shares at $175. but at the same time, I'm also selling a $170 strike call. Both expire at the same time on August 19th. Now, when I think about this, you're like, well, don't they cancel each other out? No, because this one's at a lower strike, and it's the current share price again is about 155. Because it's at a lower strike, what happens is you will collect a little bit of premium, and in this, we're just going to say $30. That's probably pretty realistic, but we're just going to, given that the strikes are way above the share price, but we will use that as the example. So let's review. We're selling a 170, buying a 175, and you're renting at $30 for it. The question is, what does that mean? So here's what this means. Let's draw a graph, okay? Because I think this graph will be important, and I'm going to lay out some lines here, and we are going to explain what it is. Okay? And so hold on. Bear with me, everybody. I gotta put the numbers in here. I think that's right, yeah. Okay. So let me do a better job writing this down. Sorry, bear with me. All right. This is what we're doing here. As long as the share price remains below 170 through August 19th, you will get max profit, which is $30 per one you sell. That's max profit. Now, as price goes up past 170 towards 175, your profit will decrease. And it will decrease. And this isn't to scale or anything, so just, I'm just doing this for illustration. But what will happen is after $170, you start losing money, right? Because for every penny, you're losing $1 of profit after 170, because it's 100 shares, penny, dollar. So you're going to eat into your premium. So your break even here is 170.30. So that means if the price closes at 170.30, you made nothing on the trade, because you got your $30 in premium. You got that no matter what, but you lost $30 on this. But what happens is, if it keeps climbing, eventually, and this should be 175. Well, no, it is 175.30. Yep, because of max loss, you have 30 cents, $30 in premium. Yeah, so at 175.30, you're at your max loss of, which would be 500 minus $30 in premium, which would be $470. And this actually should be 175. That's my bad. So I want to recap why this could be beneficial, because you're like, well, I'm only gonna make $30, but I could lose 500. You can, and you're right. And you're like, well, that's a crappy risk to reward. But first of all, Apple's at 155 right now. It has to go up, and it's run up quite a bit, right? It would have to run up another, we'll say 10% from there to even be a problem, right? What is the likelihood in the next month that Apple's going to run up 10% when I think its all-time high is 180? Yes, and the market is way down. So do you have to ask yourself that, like, and you can use tools like options profit calculator that will calculate the probability of profit. And with these kind of strategies, the probability of you being right is going to be considerably higher. Yes, I understand this crappy risk to reward here, but there's actually a good chance that you will be right. And so this is why these can be great. Like if you take a stock that has run up a bunch, maybe it's worthwhile to look into this. If you think, oh my gosh, okay, Apple has run up 20%. I don't think it can keep running like this. I'll sell a call credit spread and bank on it coming down. So it's definitely an option, and it's definitely an option that you should keep in your toolkit. If you have any questions about it, always feel free to comment, or you can follow me on Instagram at mdeepcpa or on Twitter at mdeep_CPA. And that is DEEPE, by the way. There's an extra E in there. So have a great day.